Welcome to the deep dive. We sift through the noise, the studies, the guides, and bring you the core knowledge you really need.
Glad to be here.
So today, we're tackling something so many entrepreneurs run into. You've got this big dream, right? Growing your business.
Yeah, vision.
But then, bam, reality hits, financial limits. It feels like a wall. What if, though, you could actually access serious capital for that growth? And crucially, without risking your own house or savings.
It's a huge question, and honestly, it's where a lot of businesses get stuck.
Yeah.
There was this NSBA study, Access to Capital,
Right.
and it found that over 20%, 1 in 5 business loan applications get rejected, just because the business doesn't have its own credit history established.
Wow, 1 in 5 just stop cold.
Exactly. Think about the potential loss there.
Yeah.
Businesses that could scale, innovate, hire,
Yeah.
hitting that wall early on.
It really puts it in perspective. So for you listening, consider this deep dive your mission control.
Hmm.
We're going to map out the blueprint for building solid, strong business credit. The goal, to totally change your access to funding, give your business real power, and maybe, just maybe, make sense of those confusing bank rejections.
And we're leaning on some really solid insights here, particularly from the Orion Strategy Group guides. They really break down the myths.
Think of it like learning how to responsibly use OPM, other people's money, to fuel your own thing.
And it's way more than just getting a loan approved. It's about building a firewall around your personal assets.
Right.
It's about being able to scale your operations when the time is right. And honestly, making your business look like a great bet to lenders.
So who's this for? Well, if you're just starting out, dreaming big.
Yep.
Or maybe you're already running a business looking to expand. Or you're a professional wanting that clean break between personal and business finances.
Or maybe you're just fed up with hearing no from the bank and not knowing why.
If any of that sounds like you, you're definitely in the right place. Stick with us because you're about to get the keys to doors you didn't even realize were locked.
Let's dive in.
Okay, part one, the blueprint. This is all about laying that solid legal and credibility foundation for your business. Now, the Orion sources really hammer home this idea of professionalism. Why is that first impression, that professional setup, so incredibly important to lenders?
Well, it's kind of fascinating how different it is from personal credit, your personal credit report.
Yeah.
Mostly private.
Right. Nobody else really sees it unless you authorize it.
Exactly. But business credit, a lot of that information is actually public or at least semi-public. So banks, lenders, even suppliers, they scrutinize everything. They're looking for legitimacy, for stability.
So it's like your business is constantly being evaluated.
Pretty much. Any inconsistency, like
Yeah.
a different address here, a slightly different name there, it can be an instant red flag.
Mm.
For lenders dealing with tons of applications, it's frankly the easiest way to filter out businesses that haven't gotten their act together, so to speak. It signals risk.
That makes sense. It's not just about the money. It's about looking like a serious, well-run operation from day one. So where does a new business owner even begin to build that professional image correctly?
The absolute first step, and you really can't overstate its importance, is choosing the right legal structure. Your entity choice.
LLC, corporation, that kind of thing.
Precisely. This decision ripples through everything, your personal liability, how you're taxed, how credible you look, and crucially, whether you're even eligible for business credit in the first place.
So what's the usual recommendation for, say, a typical small business?
For most small businesses, the LLC, the limited liability company, tends to be the most popular route. It gives you that vital personal liability protection.
Meaning your personal assets are separate if the business runs into trouble.
Exactly. Plus, it offers flexibility in how you're taxed, and banks are very familiar and comfortable with LLCs.
Okay, but what if you have bigger plans? Maybe you want to attract investors later on.
Then you might lean towards a corporation, an Inc. or Corp. This offers the strongest legal separation between the owner and the business. It looks very professional, especially to investors.
But there are downsides.
Yeah, it generally involves more regulations, more paperwork, and potentially higher administrative costs compared to an LLC.
Now, a lot of people starting out might just operate as sole proprietor or maybe a simple partnership. It seems easier. What's the catch there, specifically for building business credit?
That's the big catch. While they're simple to set up, sole proprietorships and partnerships are really the least recommended if your goal is serious business credit.
Why is that?
Because there's no legal distinction between you and the business. Your personal assets are completely exposed. And from a lender's perspective, there isn't a separate formal business entity to lend to. Many banks will simply reject these structures for formal business lines of credit.
Okay, so choosing the right structure, like an LLC or core, is step one. Once that's done, what specific legal documents do you absolutely need to have buttoned up to show lenders you're serious?
Right, you need the paperwork to back it up. For an LLC, a key one is a signed operating agreement. That outlines how the company works internally.
Okay.
You'll also need your articles of organization, that's the document you filed with the state, to actually create the LLC. And a certificate of good standing is often required.
What's that prove?
It just confirms your business is active and up to date with all state filings and fees. And one more crucial one, a banking resolution.
Ah, telling the bank who can actually manage the account.
Exactly. It formally authorizes specific people to open and handle the business bank accounts. Lenders often ask for these directly, so having them ready shows you're prepared and legitimate.
Got it. So the legal house is in order. What's next for building that credible business identity?
Now we build the identity itself, and like you said before, consistency is everything. First up, you absolutely need an EIN, employer identification number.
The business's social security number,
Right.
basically.
That's a great way to think of it. It's free, and you get it directly from the IRS website. Big tip here from the sources.
Yeah.
Don't use third-party services that charge for this.
Why not?
Well, first, why pay for something free? But more importantly, sometimes these services can introduce delays or even errors, which can mess things up right at the start. Just go straight to the IRS.
Good practical advice. Okay, EIN secured. What about the business name itself? Does that need special attention?
Absolutely critical. Your official business name, or any DBA, doing business as, needs to be exactly the same everywhere.
Everywhere.
Everywhere. State registration, your EIN record, bank accounts, your website, any licenses, social media, and especially when you register with Dun & Bradstreet. Even a small variation, adding Inc. here but not there, using a slightly different version that triggers alerts for lenders. It has to be consistent.
Wow, okay. That level of detail matters. Carrying that consistency forward, what about the business address? Can you just use your home address to start?
This is a really common stumble point. While it might seem convenient, using a residential address is often viewed negatively by lenders. It just doesn't project stability or professionalism in the same way.
So what are the better options?
The gold standard, of course, is a physical commercial office space. But if that's not practical, especially early on, professional virtual office services are usually acceptable. Companies like Regus, DaVinci, Alliance, they give you a legitimate business address.
And what should you absolutely avoid?
The big no-no is using a P.O. box or one of those UPS store mailboxes as your primary business address. For most banks evaluating business credit, that's an automatic rejection.
Automatic rejection, just for the address.
For the primary business address for credit purposes, yes.
Yeah.
It just doesn't signify a stable physical operating location.
That's a huge pitfall to know about. Okay, so address sorted. What about a phone number? Can I just use my cell?
Similar logic applies. It's all about projecting legitimacy and stability. Ideally, you want a dedicated landline commercial number. But if that's not feasible, professional voice over IP, VoIP services are usually fine. Think RingCentral, Grasshopper, even Google Voice, if it's clearly linked to your business domain, not a personal account.
And the cell phone.
Just using your personal cell number without any kind of business registration or service behind it, that's generally frowned upon. It looks less professional.
Makes sense. And a pro tip mentioned was registering the number.
Yeah, registering your business number with the 411 National Directory. It's another small step, but it adds another layer of verification and legitimacy in the eyes of the algorithms and the lenders.
Okay, dedicated business line. I'm guessing the next piece is a professional email address. No more mycompany@gmail.com.
You guessed it. Your email absolutely needs to be tied to your business domain. So info@yourcompany.com, sales@yourcompany.com, something like that.
And why is that so important?
Generic emails from Gmail, Yahoo, etc., they often get filtered out by automated credit application systems. But more than that, they just signal risk. It suggests maybe the business isn't fully established, or perhaps is even temporary. A custom domain email shows investment and professionalism.
Right, another piece of the credibility puzzle. So we've got the name, address, phone, email, all consistent. In today's world, that picture isn't really complete without a website, is it?
Absolutely not. Your website is your digital storefront. It's a critical validation point for lenders. They will look you up online.
So what does it need to have?
It needs a proper domain name, obviously. Clear contact information, an About Us section explaining what you do. And crucially, all the details on the website, name, address, phone, must perfectly match everything else you've registered.
And if it doesn't, or if there's no website?
Lack of a professional website or inconsistencies between the site and your official records, that definitely triggers alerts. It makes lenders question if your business is real, stable, and professionally managed.
Okay, we've built this strong foundation. Legal structure, consistent identity across the board. But how do you actually get this recognized by the financial system? How do you start building that credit profile? That seems to bring us to Dun& Bradstreet.
Exactly. Dun& Bradstreet, or D&B, is arguably the biggest player in the business credit reporting world. They issue something called a DUNS number.
DUNS.
Yep, DUNS. It's a unique 9-digit identifier for your business. Think of it like your business's global ID card for finance. For many lenders and suppliers, especially larger ones, if you don't have a DUNS number, your business effectively doesn't exist financially.
Wow. Okay, so essential. How do you get one? Is it complicated or expensive?
Good news is it's free. You can apply directly on the DMB website. There are options for different purposes, like applying for credit or bidding on government contracts. Just pick the relevant one.
And the key thing during application?
Consistency, again. Make absolutely sure the information you provide, name, address, legal structure, perfectly matches your IRS records, state registration, and bank details. Any discrepancy can delay or complicate things.
How long does it usually take?
It can vary, usually somewhere between 5 and 30 days. Patience is needed sometimes.
And once you have the number?
Then you should register for DMB's iUpdate service. This lets you view your basic profile, monitor it, and submit updates if anything changes. Keeping that profile accurate is really important moving forward.
Makes sense. All right, DUNS number acquired. Next up, something that feels basic but can trip people up, licenses and permits. You can't just skip those if you want serious credit, right?
Absolutely not. Trying to operate without all the required licenses could be local city permits, state professional licenses, maybe a resale certificate that's a huge red flag for lenders.
Why is it such a big deal for credit?
Because it signals compliance risk. It basically tells lenders your business isn't officially real or operating entirely legally. They want to see that you're following the rules, that you're buttoned up.
Yeah.
It reduces their risk significantly. Skipping licenses can lead to an immediate rejection.
Okay, so dot the I's and cross the T's on all legal requirements. Finally, in this foundation stage, let's talk about what Orion calls the financial hub, the business checking account. How critical is this?
Indispensable, truly. A dedicated business checking account is ground zero. It's not just for deposits. It's the official record of your financial activity. It proves your business is operational and, crucially, it shows that clear separation between business and personal finances.
That's often a requirement for credit.
It's almost always the very first requirement before a bank will even consider you for a business line of credit or loan.
So what are the best practices when setting one up and using it?
Number 1, make sure the account is opened in the exact legal business name. Again, consistency. Then, use it consistently for all business income and expenses for at least 3 to 6 months before you start applying for credit. Lenders want to see a pattern of activity.
And keep it clean, I assume.
Absolutely. Maintain a positive balance, avoid overdrafts at all costs. A clean banking history is foundational.
The Orion Guide also had an interesting point about how you talk to the banker when opening the account, framing its purpose.
Yeah, that was a neat tip. Instead of just saying, I need a checking account, they suggest framing it confidently. Something like, we'll be using this as our primary operating account to manage revenue, pay suppliers, and build a strong banking relationship for future credit needs.
So it signals you're thinking ahead, you're serious, you see the bank as a partner?
Exactly. It presents you as a prepared, forward-thinking client, not just someone opening a basic account. It sets the right tone from the start.
Okay, that wraps up the foundation nicely. You've meticulously built this legal and credible base. Now, let's shift gears to part 2, the launch pad. This is where we actually start building credit history using something called trade lines. What exactly are these trade lines?
Right, so you've got the structure, the identity, the bank account, but none of that builds a credit score on its own. You need activity. Trade lines are essentially business accounts, often with suppliers or vendors, that report your payment history to the business credit bureaus.
So like buying supplies on terms, net 30, that kind of thing.
Exactly, net 30, net 60. These mean you buy something now and payment is due in 30 or 60 days. These vendor accounts are often the easiest way to get started because many don't require existing business credit history.
And how does paying these bills actually build your credit score?
Pretty straightforward. When you make purchases from these vendors and, crucially, pay the invoices on time or even early, the vendor reports that positive payment experience to one or more of the major business credit bureaus. That reported activity generates your business credit report and builds your score, like the Paydex score from D&B, which is heavily weighted on payment history. Consistent, timely payments are the fuel.
So we need this activity reported. Which are the main business credit bureaus we need to make sure these vendors are reporting to? The big three.
The big three you really need to be focused on are Dun & Bradstreet, D&B, Experian Business, and Equifax Commercial. Ideally, you want positive payment history showing up on reports from all three.
Got it. Okay, this is where listeners probably want specifics. What are some good, reliable initial trade lines that a new business could open? Ones that typically report and don't necessarily need a personal guarantee or existing history.
Yeah, there are several well-regarded starter vendors. Uline's the very popular one.
Yeah.
They sell shipping and office supplies. They report reliably to D&B.
Okay, Uline. Who else?
Grainger, which sells industrial supplies, is another good one. They often grant net 30 terms after you place an initial prepaid order. Some office supplies is known for being relatively easy to get approved for, and they report to both Equifax and D&B.
That's helpful, reporting to two bureaus. Any others?
Strategic Network Solutions, often called SNS, offers IT and office products on net 30 terms and is known for reporting monthly. Office Garner is another supplier often recommended for building initial credit.
It sounds like there are also some newer players, maybe more tech-focused.
Yes, absolutely. The fintech space is active here. Platforms like Ava Credit and Kovo offer specific credit builder accounts or cards, often with net 30 or net 60 structures, and they are built around reporting to bureaus like Equifax. They can be really accessible options.
Okay, so you've identified a few good starter trade lines. You get approved. How do you then use these accounts to get the maximum positive impact on your developing credit score? What's the strategy?
Great question. Just having the account open isn't enough. First, make a purchase relatively soon after opening it, even if it's small. Show activity.
Okay.
Then, and this is really critical, pay the invoice early. Don't just wait for the 30-day deadline. Pay it 10, maybe 15 days before it's due.
Why pay early? Doesn't on time count?
On time is good, but early is great. It sends a powerful signal to the credit bureaus and significantly boosts scores like Paydex. It shows you're highly responsible and have strong cash flow.
Makes sense. Be better than just punctual. What else?
Aim to open at least 3, ideally maybe 5, of these reporting trade lines within your first, say, 30 to 60 days. You need multiple accounts reporting positive history to build a robust profile quickly.
So diversity helps.
Yes, multiple positive data points are better than just one. And finally, verify that these vendors are actually reporting your payments. Don't just assume. You might need to check your reports or even ask the vendor. An account that doesn't report isn't helping you build credit.
Right, that's crucial. Don't waste your effort on non-reporting accounts. So being proactive, paying early, getting multiple lines. What should business owners definitely avoid when trying to build these initial trade lines? Common mistakes.
Well, the biggest mistake is opening accounts with vendors who don't report to the major business bureaus. That just doesn't help your score. Another is letting these accounts become inactive. You need consistent use.
And the obvious one.
Late payments. Absolutely fatal for business credit scores. It signals unreliability faster than anything else. And one more fundamental mistake. Relying on your personal credit for business needs. The whole point here is to build separate business credit. Don't use personal cards for business expenses if you can avoid it, especially once you start getting business lines.
Got it. Separation is key. So you've got these starter trade lines reporting, you're paying early. How do you keep track of your progress? How do you know if it's working and make sure the reports are accurate?
Monitoring is essential. You can't just set it and forget it. There are services specifically for this, like NAV or D&B's Credit Signal.
What do they do?
They allow you to see your business credit scores and reports from the major bureaus. This lets you track your progress, see the impact of your payments, and, very importantly, spot any errors or inaccuracies.
Errors happen.
Oh, absolutely. Incorrect information can definitely appear. If you see something wrong, like a payment reported late when it wasn't, you need to dispute it with the credit bureau immediately. Protecting your business's credit reputation is your responsibility. Monitoring also helps you watch out for potential fraud.
Right, proactive defense. Okay, so we've laid the foundation. We've launched with initial trade lines, monitoring progress. Now for part 3, the ascent. This is about leveling up, expanding your financial power. How do you transition from those starter vendor accounts to, the bigger leagues, bank lines of credit, corporate cards?
This is where the early work really pays off. Once you've built a solid history with those starter trade lines, maybe 6 months to a year, of consistent early payments across 5+ accounts, you've demonstrated reliability.
So you look like a better risk.
Exactly. Now you're in a much stronger position to approach traditional banks, think Bank of America, Chase, Wells Fargo, or even better, local community banks or credit unions for actual business lines of credit or corporate credit cards. They'll see your established DNB profile, your Experian and Equifax reports, and be much more receptive.
And when it comes to corporate credit cards, what's the ultimate goal? What's the really desirable type to aim for?
The holy grail, as many call it, is getting corporate credit cards that do not require a personal guarantee, often abbreviated as no PG cards.
No personal guarantee, meaning your personal assets aren't on the line if the business can't pay.
Precisely. Companies like Divvy, Brex, Ramp often offer these types of cards, usually based on the business's cash flow, revenue, and established creditworthiness rather than the owner's personal credit. Getting these is a major milestone. It's true separation.
That sounds incredibly valuable for peace of mind. Okay, so you've graduated to these bigger lines, maybe even a no PG card. How do you use this enhanced credit power strategically for growth, not just for everyday expenses?
Strategy is key here. One powerful tactic is leveraging introductory 0% APR offers on new business credit cards. These can last 12, sometimes even 18 months.
Zero interest for over a year.
Yeah. This gives you a window to finance significant growth initiatives. Maybe a big marketing push, buying inventory in bulk at a discount, upgrading essential equipment without the immediate pressure of interest payments. It's like an interest-free loan if managed correctly.
That's smart. What about managing the credit limits you now have?
Even if you get approved for high limits, say $20,000 or $50,000, it's crucial to keep your credit utilization low, ideally below 30% of the available limit on each card or line.
Why low utilization?
High utilization signals to lenders that you might be stretched thin financially even if you pay on time. Keeping it low demonstrates responsible management and actually helps boost your credit scores further. Don't max out your cards.
Good discipline. What other strategic tips apply here?
Be proactive about asking for credit limit increases. If you've been using your cards responsibly and paying on time for 3-6 months, request an increase. Higher limits improve your utilization ratio, assuming your spending stays stable.
Okay.
And a big one, don't close your oldest credit accounts, even if you get newer, better cards. The average age of your credit accounts is a significant factor in your score. Keeping those old accounts open, even with minimal use, helps maintain that history.
Length of credit history matters. And diversify.
Yes, as your business grows, look beyond just cards. Explore term loans for specific investments, equipment financing or leasing, revolving lines of credit that offer more flexibility. A diverse credit mix is generally seen favorably.
It feels like the landscape is also changing with newer fintech options. How do they fit into this ascent phase?
They're definitely playing a bigger role. Platforms like Tilful, Divvy, and Ramp, which we mentioned for no PG cards, often function as both credit providers and reporting tools. They might use different underwriting criteria, sometimes looking more at real-time cash flow than just historical credit.
So they can be another avenue.
Absolutely. And there are also services like eCreditable that focus on reporting payments typically not included in credit reports, like business utilities, phone, internet, power. Adding these positive payments can further strengthen your profile, especially if your traditional credit history is still developing. It uses expenses you're already paying to build credit.
That's clever. What about the old school approach? Building relationships with bankers, does that still hold weight?
I think it absolutely does, especially with community banks and credit unions. While large banks rely heavily on algorithms, smaller institutions often value relationships.
How so?
Getting to know your local branch manager or a business banker means they understand your business beyond just the numbers. When you need financing later, that existing relationship, that trust, can make a real difference in getting approved or securing better terms. Don't underestimate the human element.
Right. Blend the tech with the personal touch. So you've reached this stage, good credit lines, using them strategically. How do you maintain this? How do you keep everything performing at its peak?
Ongoing vigilance is key. It's not a one-time fix. You need to continue monitoring your business credit reports regularly. Monthly is ideal. Keep an eye on your scores, like Paydex, aiming for 80 or higher for the best rates, and others like Experian and Telescore.
Catching errors or fraud early.
Exactly. And reinforcing the most important habit, timely payments. Always. Set up autopay where possible. Use calendar reminders. Late payments are incredibly damaging at this stage.
What else for maintenance?
If you have employees or partners using business credit, make sure they understand its importance and the rules. And keep all your information updated if your address changes or your legal structure evolves, updated everywhere. State, IRS, banks, D&B, vendors. Inconsistencies can still raise flags.
Okay, constant upkeep. Now, thinking bigger picture, scaling the business. How do you leverage this established credit power for major growth and investment wisely?
The fundamental principle is to use credit as a tool to generate more revenue, not just cover operating costs or, worse, plug holes from losses. Think return on investment.
So borrow to grow, not just survive.
Precisely. Use lines of credit to invest in things that will directly increase income or efficiency, expanding inventory before a busy season, launching a well-researched marketing campaign, buying equipment that boosts production, and a crucial piece of timing advice.
Yes.
Apply for financing before you're desperate for it. Banks are much more willing to lend to a business that's healthy and planning for growth rather than one that's struggling and needs cash urgently. Secure lines of credit when times are good so they're available when you need them or when opportunities arise.
Be proactive, not reactive, with funding.
Exactly. Have a clear plan for how you'll use the funds and how it will contribute to growth. Integrate your credit strategy into your overall business plan.
Any final thoughts on sustaining this financial power long term?
Well, don't hesitate to seek expert advice periodically. A good accountant or financial advisor can help optimize your credit usage, tax strategy, and overall financial health. And finally, think about asset protection. Using the right insurance and perhaps more advanced legal structures like holding companies or trusts as your business grows can provide additional layers of security and further build lender confidence.
Wow, okay. That was a comprehensive journey. So for everyone listening, you've just taken a really deep dive into the practical, step-by-step strategies for building truly robust business credit.
And it's important to remember, this isn't just abstract theory. We've walked through actionable steps. This is a real pathway to gaining more financial control and fueling your business's growth.
Absolutely. The knowledge gives you power, but as we've heard, it's the consistent strategic application of that knowledge that makes the difference.
You now have the keys. You understand the blueprint.
So here's the final thought to leave you with. In a business world where access to capital often defines who wins and who doesn't, how will you use these insights? How will you leverage this understanding of business credit to not just navigate the system, but to actually, well, win the system for your own venture? What's the very first strategic move you'll make starting today?